Hello. We are ready to go. Can you guys hear me? Okay, it's not gonna sound okay. There's no talking. Good afternoon, everyone. Thank you all for coming. My name is Milo, a graduate student at MIT. I would like to take this opportunity to thank MIT Sloan Real Estate Clubs and the AACRE Alumni Association of MIT Center for Real Estate who put it all together. Also, I would like to thank our sponsors. They are UIY, New Air, Keller Augusta, The Real Reporter, and Boston Properties to make this happen. It is my honor to introduce the next panel, Investing Across the Structure. Our panelist will be Amanda Strong. She is currently Director of Asset Management for Colony Realty Partners, where she is responsible for overseeing 5 million square feet of office, industrial, and multifamily assets in Atlanta, Georgia. Before joining CRP, Amanda worked for New Boston Fund, Marshalls, and Staples on acquisition, leasing, and research. Amanda earned her bachelor degree from Babson College and a master degree from MIT. Please join me today in giving a welcome to Amanda Strong. Thank you.
Good morning, everyone. It's really nice to see a lot of former classmates and Center for Real Estate, and I'm really excited because I don't know if this is the first year, but it's a great thing to see the Sloan program and the Center for Real Estate program together. So great job, you guys, and thanks a lot for the digs. Really nice to see the space, and I'm sure there's an architect for TI build out and somebody you can sign a lease with. That's just my side as an asset manager. So I guess I first want to introduce the panel. James Chung is not able to be with us today. Unfortunately, he was flying from New York, and the weather, as it may be, we had a little snow, as you know. So, but I'm pretty excited. The panel that we have today, from my left, is Mike Dorsch, Executive Vice President of Investments for iStar Financial, Ed Glickman, who's President and COO of Pennsylvania REIT, Jason Liu, who's Managing Director at AMCAP Incorporated, and Scott Hileman, Director of Real Estate at Deloitte Financial Advisory Services, LLP. One of the 4 remaining? Great, good.
504.
504. So I just wanted to quickly go through. These are just slides that I figured after lunch we needed something to, just keep things interesting. And actually, I've always had these in my mind, and in fact, they looked exactly like I thought. I had a friend at HBS who, sometime in late 08, early 09, we were looking through the Wall Street Journal, the New York Times, and every single graph that we saw was sort of the same. So we have the quarterly GDP growth rate, and that bottom there is just around March of 08 at -6. We have the unemployment rate right about the same time, -9. We have the transaction volume, I don't need to tell you, 2008, a record low. And we have CMBS issuance, which is somewhere around, 20 million or something for 2008. So I think the question, and one of the things that the panelists will be able to answer today is, and I blanked this out on purpose, and Scott pointed out when I sent out the slides that I didn't have any names on it. And my point is, I think you can take any slide from the real estate world and think about, 2011, and I think that's the question is everybody's asking is, when are we going to get back on track? Are we going to peak out like we did at 2007, and what are some of the drivers? So I think that's the last slide that I have, and so I'm going to go back and hope that my mic works. Thank you. Okay, so what I thought we could start with, and I don't know if we want to start with Mike, since you're sitting closest to me, if each of you could sort of go through your companies. I don't know, I want to tell people a little bit about what you do with your companies, and talk about the differences in the recession, before the recession with capital, and how it's affected your organization, and also how you think it's going to be sort of in the next 12 to 24 months if you had a crystal ball.
I'm Mike Dorsch. I'm with iStar Financial. Been with them now about 11 years. I had a net lease firm that I sold to them in 2000, based here in Boston. My career, started some 25 years ago in the real estate business, back when there were things called real estate syndications and tax benefits for real estate. At iStar, it's been a pretty tumultuous 10 years. We rode a fairly good growth curve for an extended period of time over the last decade, and then the meltdown that started in 07 and into 08 has caused us to sort of cease being a lender and become more of an asset manager. And so even though my title says investments, everybody at iStar has been focused on asset management really for the last 3 years. In particular, I had the distinct pleasure, I guess, of taking over our land portfolio in 2008, which was at that time 72 different loans with $3.5 billion of commitments, all on development of land, primarily for residential construction, single-family residential construction. As you can imagine, it's been a kind of a wild ride for the last couple of years, as that portfolio is now 43 assets, and half of those assets are owned assets, and transitioning the mindset of people that were junior capital holders, whether they were junior lenders or whether they were equity investors, that if I was impaired, they were certainly underwater, and transitioning that to an ownership position, and now ultimately figuring out how to get a return of capital over time in a space that is still challenged in the home building sector. So a lot of times that involves real development activity, re-entitling dirt, preserving entitlements that you do have, and figuring out what a home buyer wants today, because that's what the home builder needs to be building, and that's who my constituents are. So our portfolio is across the country, really starting the middle Atlantic. I think you said, Amanda, earlier, the smile, but starting the middle of the middle Atlantic states, running down through Florida, across to the southwest, and up the California coast. Total portfolio is about 70+ thousand lots approved for single-family development.
Thanks. I'm gonna use my slides.
Yeah.
Great, thank you. I'm Glickman, president of Pennsylvania REIT. Let's see if I can move this along. So we have about 34 million square feet of shopping center space, including regional malls and power centers. We have an East Coast portfolio, our headquarters in Philadelphia. And we, along with a company that used to be in Boston called Bradley REIT, I don't know if any of you remember it, and Washington REIT were the three REITs that were formed right after Congress passed the act in 1960. So we're one of the two oldest surviving real estate investment trusts, which, by the way, we're very happy that we made it to 50 years because we had a kind of wild ride last year, as did a lot of other people. This is our portfolio, or the core of our portfolio is Jersey, Delaware, Maryland, and Pennsylvania, where we probably in the space below New York and north of DC have about a 40% market share of retail space. So just for you who are not that familiar with REITs, where companies that are formed to own commercial properties have to be held by 100 shareholders. There's about 150 public REITs now with about $300 billion worth of capital, and very conservative. Our leverage as a group is somewhere below 50%. During the last year, we were a sink for capital because, one, we had to restructure our own balance sheet, but secondly, we were considered to be the vehicles that were going to go out and right the distress, as we did in the early 1990s, where a flood of capital came into the REIT structure, and it was used to put an end to the S&L crisis. Typical capital stack in a REIT, there's a lot of REITs that are rated and they issue public debt. So if you think about the current problems that we have now with CMBS debt coming due and not enough CMBS debt to replace the maturities that are coming due, public REITs actually can go and finance as corporations. They can issue rated debt. They can raise money in their corporate balance sheet and use that to pay down some of the money that's been borrowed as mortgages. We use mortgage debt. We do CMBS, but we also take a lot of balance sheet debt in. The larger iconic properties that REITs own are financed many times by life insurance companies and pension funds. A lot of REITs use bank credit facilities to pay amortization. We also use them to warehouse acquisitions, and we use them to work our properties. REITs go out and issue a lot of hybrids. We do a bunch of converts and preferred, and recently we've been a large source of that to convert and preferred investors. Now the market for REIT preferreds is very strong. We do JV equity. A lot of times financial institutions like to use our operating platforms, and they love the fact that we have a significant level of financial transparency so that they can see into everything that a public REIT is doing. We like their money because it levers our operating people. We get to promote generally when we work for them. One of the nicest parts about operating a REIT is we can issue what are called operating partnership units. For those of you who aren't familiar with the REIT structure, a public REIT, generally, its major asset is the ownership of a partnership, which in turn owns the individual assets. And that partnership can trade its units for the partnership units or the partnership shares of a legacy asset that's owned by individuals. So they land up getting what are called OP units, operating partnership units. Upon death or upon their interest in liquidity, they can trade those operating partnership units with the REITs, get shares back, and sell those shares on the New York Stock Exchange, which is where most REITs are listed. So this has made REITs a very powerful acquisition tool. Last thing, common equity. We go out all the time and raise common equity because REITs have to distribute 90% of their earnings and profits, so we don't really accumulate capital. We're constantly raising more capital in the marketplace to buy assets. So that's to speak about what's changed in the last couple of years and how it's impacted REITs. Equity's been wildly volatile in our space because, think about it, if you wanted to short real estate, I know we heard about options on the index market, but generally the way to short real estate was to short REITs. So when people got all freaked out about the real estate market after the crash, they went and they shorted REITs. So the equity became highly volatile. Right now, once we were then considered the savior of the real estate market, capital started flooding into REITs because we were expected to be the entities that would exist and come and buy all the properties. Banks, seeing that we had many ways to access capital, thought they could get their money out. They cut down a lot on the line of credit lending, pulled back the amounts of credit that were lent to the REITs. Now they're out there calling 10 times a day trying to give us more money again. The rated debt market was also highly volatile. Again, this was a place where it was considered to be somewhat a pari passu with CMBS. So when the CMBS market got into trouble, people sold off the rated debt of real estate companies. Now real estate companies are going and raising money again at incredible spreads and in great quantity. Mortgage-backed debt, we're being approached all the time by banks that want to give us quasi-bridge mortgage debt. The CMBS market is clearly returning, and insurance companies are coming out and lending money again. Another change, banks and life companies, they provided